While everything seems to be down from all-time highs, the tech sector is continuing to hit massive numbers. The S&P 500 is one of the best ways to track the health of high-cap stocks in the US stock market, and we can see how current events have influenced it. A massive drop, and then a shaky recovery. QQQ is a massive tech-focused ETF that tracks the NASDAQ 100 index, and which provides a great look into the tech sector of the stock market. Now, QQQ isn't purely tech-based, but it is dominated by large companies like Amazon, Facebook, Google, Apple, etc. We can see the nearly unimpacted growth compared to the general stock market, and an all-time high currently being hit. Really, it begs the question, is tech overbought? I think there's a lot that goes into that question. Yes, it's concerning to see such massive growth so fast. There's always going to be a fear that it's inorganic. So I want to cover a few reasons why tech isn't and is overvalued. If a company is making a lot of profit or dominating a field, then they will have the resources to innovate, expand, fund the company, and pay large dividends to the investors. So naturally, their stock should have a value that reflects that. Think about it. If a company is making strides in influential fields, then more than likely, they aren't going to be a penny stock. Tech-focused companies, which often deal with software, don't necessarily have the limitations on growth that other companies might have. If a steel manufacturer wants to expand, they will typically need to increase physical presence, things that could take a while. Imagine trying to increase your steel company by 30, 60, whatever percentage. There's a lot of logistics involved. With software, the overhead is very different. You can't process more steel without facilities to do so, or some sort of subcontracting agreement that eats into profits. But more people can purchase or license your software without any requirement for hardware, other than maybe things like servers or customer support. But even then, it's dramatically different in the tech field. Companies like Microsoft get away with horrendous support given the reach of their software, especially Microsoft Windows. Overhead obviously exists, but if you are a software-focused company, or a large amount of your company is based off software, then you'll tend to have much lower overheads and less limitations on growth due to physical facilities. Additionally, these companies are working on technologies that could legitimately change the world. Machine learning, automation, self-driving, these are technologies that have the power to reshape our world. The transportation industry alone accounts for over 13.3 million jobs, around 9.1% of workers in the United States. Imagine a technology that cuts that in half, or even just 8%. An 8% reduction is over 1 million jobs. The profit model a lot of these companies are utilizing is very powerful. Have you noticed that tons of companies have gone towards subscriptions? Software as a service is what they call it, and it's become popular not because it's consumer friendly, but because it's an extremely easy way to consistently extract money from someone. Consider the way Microsoft dealt with Windows before. They would release new versions every few years and hope people like the new versions. If people like them, then they would make a lot of money. If not, they would have wasted countless man-hours, money, time, and development efforts on an unprofitable product. And this is the way they worked with a lot of their software, not just Windows. That's operating like a traditional company, like a car company. A car company invests a lot to create a new model of car. If that car doesn't sell well, then they've wasted an absurd amount of money and resources on something that isn't profitable. Now, you don't need to set up a factory line to make Windows if you're Microsoft, but it does make sense that selling your software every few years is not the ideal business model. Subscriptions are genius because it's human nature to tolerate massive purchases if broken up. Think how car dealerships only ever want to discuss price as monthly payments, not the cost of the car. Especially recently, there have been continued steps to make car loans longer and longer so minimum payments can be lower or your car can be more expensive while keeping the same monthly payment. That's how they approach things. Monthly payments. Oftentimes when people are subscribed to something, they don't want to constantly subscribe and unsubscribe. Maybe they subscribe to Spotify and then they go a month without using it or only use it a few times a month. Or they go on a long hiking trip and don't use it for a few months. Rather than unsubscribing the second they're not getting value out of the service, people generally think, I'll use it occasionally, or I might need it in the future. Planet Fitness is subscription-based and really focused on the assumption that most people won't use their service. People sign up at a very, very low cost, and they don't actually go to the gym, or maybe go only once a month or once every 2 months, but they don't cancel because occasionally they go, or they keep telling themselves, I'll get serious about the gym this week, this month, this year. If everyone with a Planet Fitness subscription visited twice a week, then their model wouldn't work. It's the same thing with software. So many people just let these small subscriptions run in the background, automatically being charged through their credit cards each month. These small automatic payments are things that people almost never really feel. It's different when you physically have to hand over money to someone. I help a lot of my friends with budgeting, and it amazes me how many people have tons of subscriptions. I know a lot of people won't identify with this mentality, and really I don't personally identify with it at all. I always try to minimize anything I view as waste. I don't want to keep subscriptions that aren't offering value to me. But you need to realize that this has become the norm for the average person and even corporation. Many of these organizations and people have tons of subscriptions that they continue running even when they aren't providing them a net value every month. This, combined with microtransaction, leads to a very sustainable and consistent source of profit for a lot of companies. Even companies like BMW are trying to get in on this by having a car that you purchase that has subscriptions for the hardware. Each BMW is going to come with heated steering wheel hardware, but you'll have to pay a subscription, which causes your car to enable the feature. It's not consumer friendly at all, but it's easy money. Another important thing to consider is that tech has a wide age range. There are a lot of older established companies as well as new startups and midlife companies. Tech ETFs are, in a lot of ways, the ideal mix of aggressive growth and solid hallmarks of the industry. This is an appealing mix for both institutional and individual investors. The acquisition nature of the tech sector also fuels this. It's a business model for a lot of companies to do something exactly the same as a big company, and once they get any attention, they get bought by that big company. I've said a lot of nice things about tech, so now it's time to say some not so nice things. We do have to consider the price to earnings ratio. While the price to earnings ratio isn't a perfect metric, it gives a simple and often effective look at a company. And it's just that, the market value per share divided by earnings per share. A simpler way to view it is the ratio of how much an investor is willing to spend on a stock to the earnings of that stock. So a PE of 20 would mean investors are willing to spend $20 for $1 of the current earnings. So naturally, a very high PE would imply the stock is heavily overbought. The median PE of the S&P 500 is around 15, and generally we see it fluctuate up and down. But these huge numbers exceeding 30, 40, 50 is a little concerning. QQQ has a PE of just over 29, noticeably higher than the S&P 500. And beyond that, look at some of the massive numbers present on current tech stocks. We have a PE ratio of 30, 35, 29, 78. 11.33 is pretty reasonable in a lot of ways, depending on how the company's doing. Adobe's at 60. Square is nearly at 200. Autodesk at 181. A single semiconductor company, 139. And yes, our favorite meme stock, AMD, is at a whopping 134. By many metrics, tech is very overbought given the current performance. However, investors are betting on a certain amount of growth, a major amount of growth. If that growth does not occur, we're likely to see a dump or bleed off. I wouldn't be surprised if we see a correction or stagnation for a while, but I'm not certain a bubble bursts like the dot-com bubble. These are massive, profitable corporations with surprisingly low overhead, consistent business models, and shocking amounts of influence. I also suspect that ETFs that have a lot of smaller to medium companies might be the most affected by a correction, when the smaller companies who have been inflated by all the money dumped into the sector are reevaluated or the hype leaves them. Tech could live up to expectations of investors, but I imagine a lot of that will be solid companies that are well managed and well planned, rather than all the messy, mismanaged companies living off hype. Ultimately, no one has a crystal ball to tell us the future. Just realize when you're investing in these huge PE companies, you're betting on the future, not immediate short-term performance. And yes, these companies are dealing with technologies that could fundamentally change the way we live our lives. But not necessarily every single company is going to be a winner in that field. Not too long ago, tons of companies were saying we'd have self-driving cars in a couple years. But as we found out, the problem is a lot more complicated than initially anticipated. And that's something to consider whenever you're investing in tech. You're betting on the future, and the future might not pan out the way you expect.